morning, everyone. How are we doing today?
Good morning, Zoe.
Morning, Zoe. Morning, Lisa. I don't know about you guys, but I have just landed in the UK and it's absolutely, I mean, I'm in the north, but it's freezing here. Hence why I have a big, thick scarf on in the house. I mean, it's freezing, isn't it? It's definitely Christmas is around the corner now.
Christmas is definitely around the corner. I'm not too sure how it is the 8th of December as I was checking this morning, but we're still here for today's Financially Speaking, which is all about debunking last week's major headlines to hopefully help you get that little bit closer to financial freedom. I think as we're all here as well, I will kick off with today's briefing. So the agenda, if you're new here, if you've been a few times, you'll know already what it is, but I'm going to break down one thing that the three of us have done to get that little bit closer to financial freedom before going into what's happened in the UK, the US, taking a look at a read of the week, before also looking at Europe and the rest of the world as well. So I'm going to hand over to what we've been up to this week to get that one step closer to financial freedom. But before I do, just in case there are any questions whilst we're going through, you can always ask away on the Slido link, which I believe has been shared. And Lisa will tell us a little bit more as well. Lisa, do you want to go first?
Yes, mine isn't super adventurous this week, but basically next year I've got a big trip planned, so I'm just kind of budgeting for that trip at the moment and understanding how much that's going to cost and how much more I need to save towards it. So nothing super big for me this week, but making slow steps here as always towards financial freedom. Over to Victoria.
You know what? That's so funny because mine's very similar. And actually, I know you say it's not super adventurous, and maybe that's true, but I think that it's just important to remember how important the kind of financial foundations and getting those right are. And actually, all of it starts with good cash flow, good budgeting, good mechanisms for allocating your money. And that's exactly what you've done. And similarly with me, I have just finished allocating. I get paid at the beginning of the month. And so I've just finished allocating my Christmas budget. So I have absolutely no need to stress or worry about what I may or may not spend over the holiday period, only to wake up in January in a panic that my goals have been derailed because I've already set aside. I actually save up for Christmas during the year. Most of my shopping is done, but of course we have so many Christmas parties, a lot of eating, a lot of drinking, and so just to have a fund set aside for all of that, it leaves. I think actually these things really do speak to financial freedom. I think we often forget that these subtle things also have a massive impact when it comes to being and feeling financially free, because you can then spend and enjoy these lovely times without guilt. So very similar to you. And Zoe, what have you been up to?
Unfortunately, it's going to be tying in with a very similar to the two of you as well, but I guess it is a sign of where we're at in the year and what it kind of presents to us, at least within our own festivities of Christmas. I've also been looking in a little bit at the budget to make sure that it's all going to even out across the month. I've checked in on things like credit cards because, of course, last week was one of the first days of the month. So things like credit card bills are due to be paid and paid salaries and things like that. So it was also an equally sort of check-in moment for what's to come. As you say, it's always an expensive time. So I think it's important for everybody. It's also important to remind everybody that we do also have to do the slower, more boring things sometimes, as well as the more exciting check-ins as well. So a little bit of everything. Thank you.
I think on that point, just to say, I think that doing the slower, boring stuff means that we can enjoy the fun stuff without the guilt afterwards. So I am totally with you. And I personally think it's so worth doing the boring stuff to then, like I say, enjoy the good stuff without guilt and without stress afterwards.
Yeah, I agree. Absolutely love it. So on to hopefully some more exciting stuff then, which is, of course, this week's briefing. So taking a look at the major markets first from last week. The FTSE 100, which is a measure of the 100 biggest companies in the UK, fell by 0.55%. That is slightly down, but not nearly as dramatic as what we saw in the sort of 2 to 3 weeks prior. The S&P 500, which is a measure of the 500 biggest companies in the US, so gives us a general market reading of what the US is up to, rose by 0.85%. This is certainly good news for some of the turbulence that there has been, even if it's not necessarily a huge rise. The NASDAQ, which is the US tech-based index, rose by 1.75%. Again, good news, and tech's had a tough few weeks, particularly the NASDAQ index as well. So this is really pointing in a direction that most people want to see their markets and the investments going. And then the Euro Stoxx 50 rose by 1.13%. This is a measure of the 50 biggest companies in the Eurozone, and again, is positive news. So overall, what we can see here, FTSE 100 aside, is that for the week, most major markets have been relatively positive. December is normally a more positive period on markets. There's all sorts of reasons for it. Sometimes towards the end of the month, we get what's called a Santa rally, where we see the markets really pick up into the last few weeks of the year. People believe that this is because traders, who form a huge bulk of the activity on the markets, go on holiday, clock off, and so the trading volumes are much lower. This generally means that when the volumes are lower, any mini movements are even bigger. They're kind of magnified. But generally, because everyone's in a festive movement and we're reaching the end of the year and people want to close out their books in a positive way, we tend to see that the markets do lift throughout December and into the end of the year as well. So this is a helpful reading to sort of check in on some monthly patterns. Traditionally, there are better and worse months across the years within the markets, and some of that is kind of to be anticipated. What that means is that if you're a relatively new investor and you haven't seen these patterns play out before, you can now start to understand how and why some of this happens, and understand that it's not even necessarily within the wider geopolitical spheres or anything else going on in the world, but rather just what we generally see as a pattern. And it can help you, therefore, to predict as and when you might make relevant changes, or as and when you might hang back off making these relevant changes, because, well, we always see that December's good, January generally isn't quite so great. And same again for the sort of September, August period for similar reasons tied to generally holidays. So on to then what happened in the UK, where whilst the FTSE was down ever so slightly, there was relatively positive news coming out of the economic readings, as well as the pound sterling, the UK's currency. There was data released that showed stronger UK business activity. And in the midst and the realm and the aftermath of the UK budget, concerns were really eased because there's no more speculation and we now know what we're dealing with. All of this combined helped to lift the value of the pound to a 1-month high. This has also been helped and supported by weak data coming out of the US in the same week that's around business activity, as well as the dollar also being relatively weak at the moment. In reality, the dollar's been relatively weak for the best part of a year, owing a lot to the various different tariff policies that Trump has introduced and a lot of the volatility that we're seeing in the US. Now, there's pros and cons to having both weak and strong currencies for all nations. And at all times, they're kind of treading a perfect line. It relates to almost Goldilocks, a fairy tale that we have here in the UK, whereby they're just trying to get it just right, because too strong isn't great and too weak also isn't great. But a stronger pound temporarily helps to boost import-heavy UK stocks. It also just helps to boost sentiment. If the pound is strong and it's easier for domestic consumers, so the likes of myself who's in here in the UK, if it's easier for me to buy things from overseas, just psychologically, things feel better. And generally what that means is that if consumers are more positive, they're more likely to spend a bit more, be it on imports or be it generally at home. It does put pressure on exporters, however. So those that are exporting the goods and others are having to buy them in pounds that have suddenly become more expensive, they might have a slightly tougher time still selling them at the same quantity or level. However, what it does overall is it also improves the kind of overall view on recession fears and encourages some level of cautious risk taking. So overall, what this means for you, your money and your investments is that it's been quite a positive week. A slightly stronger pound, a good reaction to the budget, and a slightly stronger business activity report have all pointed towards quite a good end to the year for the UK. If you're looking at UK-based investments, whilst this week we were down slightly, overall we're at more than the S&P 500, which is relatively unusual. So for your investments, it's been relatively rosy, and equally for your money, hopefully things are looking a bit more positive too. So that's a nice festive roundup for us on the UK for those of us that are here. On to now over the pond in the US, which of course drives an awful lot of the movements and activity that we see within our own investments. It was announced last week that Wall Street expects further S&P 500 gains in 2026. So whilst I mentioned there that the FTSE 100 is just slightly outperforming the S&P 500 for the year, the S&P 500 has still had relatively strong growth and is hovering somewhere around the 13% mark at my last check. This further gains that are expected in 2026 is again further positive news. The announcement came that it was going to be driven by supportive policy within government, as well as potential Federal Reserve cuts, so cuts to the interest rate, which help to stimulate the economy, as well as broader earnings growth and big tech growth. Most companies now have given us their Q4 earnings report for the last quarter of this year, which means that they've told us how they've performed financially, but it also means that they've told us how they expect to do into the first quarter and even into the first half of next year. That's why Wall Street can now make these assertions that actually company growth looks quite strong, because they've got loads of data from all the major companies that are listed on the US stock market. And it's all pointing towards relatively positive signs. So what does this mean then for you and your investments? Well, these positive forecasts really, again, encourage a little bit of cautious risk-taking from investors. Consumers and investors all love a bit of positivity. And generally what it does is it drives the markets that little bit higher as we move into the end of the year. You may well see this reflected within your own portfolios as well. We might also see the likes of a little bit of easing of worries around the talk of the AI bubble. There's been so much chatter about fears around a bubble building, particularly on companies that are in AI and on companies that are dependent on tech, let's be honest, because they believe that their valuations have gone beyond what they're actually worth. This talk of an AI bubble causes a lot of fear and speculation, and inevitably that causes lots of volatility, so lots of ups and downs in the market, but also arguably a slightly compressed market, so lower than what it could be. With this positive news coming into the end of the year, hopefully it dispels some of those fears as the actual data has come through from most companies, and it's still pointing towards relatively a strong case use for AI. So then on to the read of the week, where the Financial Times released a really interesting article about why your cash fund is not risk-free. So for anybody that's unaware, there's multiple different ways to hold cash, and cash has to form part of all of our makeup and portfolios. Normally we say that before you start investing, you should always have some sort of emergency fund. Often we say this should be around 3 to 6 months of expenses. Usually people keep this in some sort of accessible bank account known as a cash account. Now, I know sometimes when we talk about cash, the first thing that springs to mind for people is notes and coins. It's very rare nowadays that people actually hold notes and coins as their way of holding cash, and much more commonly, it'll be in different bank accounts. But Not only can you hold cash in bank accounts, you can also hold it normally in investment accounts through things known as money market funds. Money market funds are often a big basket of different cash-based products. So they'll either be super short-term bonds, notably probably government bonds. They may well be different instruments that are also working mostly in cash, and therefore they are seen as super illiquid, but also relatively low performing, and therefore also relatively low risk. But the cash funds are not protected in the same way that, for example, your bank account is. They also use sometimes relatively high risk short-term instruments that can face some valuation, liquidity, and credit risks. So money market funds are not without risk. And if you see, for example, a cash fund in an investment account and you want to add it into your portfolio, do just appreciate it's not going to be the same as holding cash in the bank, where you might have relevant government protections in place, such as here in the UK, we have the FSCS protection that covers you up to 85,000, going up to 120,000 pounds for money in that bank account. Cash funds, are a little bit different. Taking a look now at Europe. First up, France's auditor warned that spending cuts, not new taxes, are essential for the future of the health of their economy, but also to try and avoid political gridlock that is currently threatening budgets. France have got a tricky situation on their hands. They've had a few issues passing relevant government motions to try and get their budget into place, and they really need to do it to be able to align with EU deficit goals and also the EU's conditions around long-term fiscal stability. Fiscal uncertainty may well weaken French assets by also raising borrowing costs and deterring investments. What this could mean is that while stalled reforms risk slower growth and reduced competitiveness, we're also seeing an ongoing stagnation. France, as I say, have got a tricky situation on their hands, and this will probably move into next year as well, but deadlines are creeping in from the EU. Whilst there is political turmoil in place, what we often see is that a country struggles when it comes to the likes of their own indexes and also their own stocks. Not always, but generally. The reason being is that because there's volatility behind the scenes with, could the regulations change? What's this going to mean? What will this look like? And so on and so on. So what this generally means for you in your investments is that there's some underlying tension and volatility within the wider European Union space, and therefore within the European investment market, but also within France itself. So if you've got investments in Europe or indeed in France, then you'll probably see just a little bit of a rumbling until some of this is passed. France has one of the highest deficits in the EU, and their spending to GDP, so how much they spend versus how much their country makes, is also at one of the highest levels. This needs to change, but they just need to find ways to do it that appeal to, of course, all the voters, that are seemingly fair, and that also get beyond all of the ministers and the government to agree to them. On to Italy as well, another major player in the Eurozone, where the ECB criticised, so the European Central Bank criticised Italy's proposal to classify their central bank gold reserves as public property. Italy has the third largest reserves of gold in the world. They really have a lot of it. Now, usually what happens with a country's gold reserves is that they're owned by the central bank. And for the vast majority of countries across the globe, but notably particularly in the Eurozone where it's mandatory, central banks are independent of what the government is doing. The key reason for this is because their job is to maintain economic and fiscal stability. So they need to be independent, or at least it's argued that they need to be independent, so they can do this agnostic of whatever is going on within political parties, and they can make relevant decisions that are best for the economy, not necessarily best or most appealing to voters or whatever else is going on. Now, we're in a funny period as a world for central bank independence. We're seeing Trump, for example, exert ever more pressure on the Federal Reserve, the central bank in the US, claiming that he's going to be changing the chair and also mixing things up a little bit. What this could mean is that if we do start to see central banks, for example, in the US, become less neutral, others may well see that as an indication that they too can follow suit, basically. But this could cause some real tensions down the line. One of the reasons why the European Central Bank has criticised Italy's proposal to do this to their gold is because essentially they are concerned that Italy's government could therefore use those gold reserves to bail it out of any sort of issue that it had, when it's not really supposed to see that as its own money. I'm not saying that that's what they are going to do, or that they've said that that's what they're going to do, but that is what their worry is. So what does all this mean then for you and your investments? Well, again, it relates to that kind of underlying tension that we're seeing. And as we think about our investments into the new year, we're likely to see that kind of rumbling onwards. The seas are not calm. There's definitely some choppiness, at least on the surface and underneath the water as well. And it's just things to be aware of as you're looking at your broader investment portfolio and anticipating what might come. It's understanding how this could pan out as well. It might not all be hunky-dory plain sailing. We're not yet predicting a full fat bear market. On we go. We're climbing up and up and up. Sorry, bull market. We're climbing up and up and up. Here we go. But rather, we're likely to just see some of these geopolitical, other tensions rumble on and hope potentially hold stocks back a little bit as well. So on to then the rest of the world, where firstly in China, we saw them begin to issue rare earth export licenses. This signals greater stability within China, but also for global and various different cross-border relations. It also eases fears around global supply chains that these rare earth minerals really do provide. Many industries, the automobile one being a notable one, had been hit by a reduced supply chain of rare earth minerals that they really, really need in their creation and the building of the relevant cars that they're making, or indeed within tech as well. They'd seen some slowing. When supply chains slow, we see everything else slow, and we also see those worries creep back in. So supply chains picking back up is really good news for you and your investments, because what it means is that there's a bit more flow, there's a bit more buoyancy, and hopefully with that, a bit more consumer confidence as well. And suddenly that cycle starts to look that little bit more positive again. Over to India, where India cut their interest rates to 5.25%. This is amid really strong economic growth, which is a potentially unusual move. It's not always what happens when an economy is growing. But they do have minimal inflation currently in India and have been able to raise their forecasts. So the hope is that this cut injects a little bit more liquidity into the system. So a little bit more money is spent, and therefore it's kind of moving around the cogs of the economy. And the rupee has weakened slightly along with this, again, just easing things up and hoping to keep things moving as quickly as they have been doing. So what does this mean for you and your investments? Well, I know that somebody joins who's got a relatively large investment in India, and indeed many of you may well have other investments in India. It's a huge growth area, and they're really showing that with measures like this, growth is at the forefront of their mind. It's certainly something that the government is prioritizing, as well as the central bank, and it's something that they want to continue into next year and hopefully for many years to come as well. And last but not least, where we saw a deal signed between the Dominican Republic of Congo and the US. Now, this was kind of a dual deal. Actually, it was a peace deal as well as a minerals deal. Some are arguing that the signing of the deal is more in the interests of the US than Congo and the relevant nations that have also signed the peace deal. We shall see. What this essentially allows, though, is the US to secure more access to cobalt and copper, again tying in with those rare earth minerals, alongside other major infrastructure financing. Now, cobalt and copper form major parts of lots of tech industry aspects, parts that go into bits of technology. They underpin the likes of chipboards and batteries. And what that means is that, again, when there's a slowing of the supply chain and the US don't have access to them, or indeed any other nation, then they can't make as much tech, or they can't put out as many tech products as they were doing before. With, again, another deal signed this week on those rare earths and securing access to the likes of cobalt and copper, hopefully this helps move supply chains even more and also secures more access to different ones, which can help to balance out potential supply chain hiccups in future. So what does this mean for you and your investments? Well, I think these rare earths that have popped up now twice in today's money briefing, but actually will continue to pop up, are really something to watch. They're not just something that is removed from all of us, something that's dug out of the ground and sounds kind of exotic, but rather, as I say, they'll be in our laptops, they'll be in our phones, they'll be in any relevant batteries that we have. They'll be in our cars if we drive cars. And if we don't have access to them, all of those things, just quickly think through the items I've listed. If we can't get new ones, if they break down, you can quickly see how an economy starts to slow, and also what the impact of that could be on relevant investment markets and consumer confidence as well. So all of this is relatively good news for the next year to come, and also for the ongoing movement of global supply chains and the things that we use on a day-to-day basis. So I'll come now onto the Q&A. Do ask away if you've got any questions in that Slido link that should have been in the chat. No such thing as a silly question.
Thank you so much, Zoe. We've got a few questions actually, so we'll get started with them. The first one is, do you have a workshop or any format which could guide us as a wrap up for 2025 prep for 2026?
Yeah, great question. And we do. We have a webinar on Tuesday night, I should have mentioned that, which is focusing all on the major themes of 2025 and guiding you through what 2026 can look like and how you can get yourself set up financially for success for that.
Amazing. Sounds fantastic, Zoe. And then somebody's asking, I'm confused. I found so many FTSE ETFs also covering Asia, Europe. Wasn't it UK specific?
Yeah, it's a really good question, and it is really confusing and a little bit silly. So essentially, an index is just a list of a major part of a market. Now, these lists get created by certain companies. So FTSE is a company in this example, and they have created the list of the FTSE 100. Now, the FTSE 100 is like their most famous list. So that's the one that we all know and that we all follow. Now, if we think of the S&P 500, that's owned, that list, by Standard & Poor's, S&P 500. But Standard & Poor's also make other lists and indexes, and they own them. It's just that we know the most famous one. So when you're looking at other ETFs and you see, for example, FTSE, and then you might well see like FTSE Southeast Asia major companies, and you're like, hang on, why is the FTSE there? It's just because that's the company that owns the list. It doesn't mean that there's any necessarily relation to the UK. It's not tied in with the FTSE 100, which is the 100 biggest companies in the UK. It's just another list that they produce that you can follow with an ETF.
Fantastic. Thank you so much, Zoe. And one more here. January sounds like a good month for investing then.
Yeah, January is a funny one. So a lot of it hinges on how the end of the year closes up in terms of how December finishes and what the whole year has looked like from an investment perspective. January tends to come back with a bit of a bang, but can also be a bit of a bust month. It's generally one or the other. I know that sounds obvious, but it really does have a bit of drama to it because people have come back. People are now ready and raring to go again. And so it swings one way or the other. As I said, I'll be doing a whole webinar tomorrow night at 6 p.m. UK time. So do join that if you want a bit more of a lowdown as to what we think 2026 is going to look like as well.
Perfect. Thank you so much, Zoe. And that was it when it comes to questions.
Brilliant. Awesome. Well, hopefully see you all soon next week. Have a lovely day and a great week.
Thank you. Bye-bye.
Bye for now.